Let me give you the conclusion first. A JPMorgan strategist just sent his clients a note that says this: what is happening in the market right now looks exactly like 1999, the year right before the dot-com bubble exploded. And he did not say it based on a feeling. He said it with numbers. The semiconductor index is up 87% this year, its best quarter ever. But Microsoft, the company buying all those chips, is down 18% year to date and just had its worst month since the year 2000. Chips are exploding higher. The company buying them is falling apart. That is the exact same shape the market had in 1999, and 1 year before everything came crashing down. And JP Morgan said something very specific. Watch this. All the way through summer until August. In the next 9 minutes, I'm going to tell you exactly what that means and exactly what you need to check. Here's why you need to watch this. Right now, everyone online is fighting about one question. Wait, is AI a bubble? Yes or no? But that is not actually what JP Morgan said. They said, watch these specific stock charts through August. If you only hear the word bubble, you miss the real signal completely. My name is Moon, and I spend an unreasonable amount of time reading the actual source reports institutions send their clients, not just the scary headline someone wrote about it. If market noise like this makes you anxious about your own portfolio, hit subscribe now. And if this video helps you, please tap that like button too. Okay, look at this. Inside the AI trade itself, money is splitting into two completely different directions. On one side, hardware. The Philadelphia Semiconductor Index is up 87% this year. A memory chip ETF that only launched in April is up 141% since it started. Money is flooding in here. On the other side, the four companies actually buying all that hardware to build data centers: Microsoft, Meta, Amazon, and Alphabet. An ETF tracking those four hyperscalers is down 7% from its peak. Meta specifically is down 5% this year. Microsoft is down 18%. Let me put a real number on that. If you put $10,000 into Microsoft at the start of this year, it would be worth about $8,200 right now. But if you put that same $10,000 into the semiconductor index instead, well, it would be worth over $18,700 today. Same AI theme, a $10,500 gap. This exact split happened in 1999. Companies making internet networking equipment soared, while the companies spending huge amounts of money to actually build out that internet infrastructure collapsed from their highs. That is the pattern JP Morgan is pointing to right now. And here is where it actually gets interesting. This 1999 comparison came from JP Morgan's technical strategist, Jason Hunter. He is the guy who studies charts and money flow patterns. But inside that same building, JP Morgan's global research team released a completely different mid-year outlook. They said total AI capital spending will reach $5.5 trillion through 2030, and that hyperscaler operating cash flow will pass $900 billion by 2027. Their conclusion? This investment is profitable. So inside one single company, the chart team is flashing a warning sign, and the fundamentals team is calling it a profitable investment. What that tells you is even JP Morgan cannot fully agree on bubble, yes or no. But both teams are saying the exact same thing you should be watching. Hunter wrote it directly. Watch whether these hyperscaler stocks find their footing over the summer, because that determines whether the market faces a sentiment-driven setback heading into fall. But honestly, every headline running with this story right now says JP Morgan warns AI bubble about to burst. That is only half true. You might be thinking, if JP Morgan themselves compared this to the dot-com bubble, how is that not a warning? Fair question. But in the actual note, Hunter never said the bubble is bursting. He said this setup keeps our focus on individual hyperscaler charts. That is a watch list, not a prediction. Here's what most people miss. Fed Chair Powell said clearly last October that AI is different from the dot-com era because these companies are generating real revenue that is contributing to actual economic growth. But at the same time, veteran strategist Ed Yardeni pointed out that expected long-term earnings growth for the S&P 500 just hit 20.2% higher than the 18.6% expectation investors had right before the year 2000 peak. The reason this gets confusing is simple. A headline that says bubble yes or no gets more clicks. But what institutions are actually doing is not answering yes or no. They are watching a conditional signal, and that nuance disappears the moment it becomes a headline. So here is exactly what to check between now and August. Number 1. Do Microsoft, Meta, Amazon, and Alphabet stop making new lows and start stabilizing this summer? Continued new lows is a warning sign. Sideways movement followed by a bounce means the rotation is running out of steam. Number 2. Are these 4 companies actually converting their spending into revenue? Combined, they are on track to spend $725 billion on AI this year, 77% more than last year. At that scale, every earnings call becomes a critical checkpoint. Number 3. How extreme does the gap between chips and hyperscalers get? If semiconductors keep ripping higher while big tech keeps falling, that gap widening is exactly the scenario JPMorgan is worried about. Number 4. Market psychology as we head into fall. A hunter specifically flagged a sentiment and positioning-driven setback risk in autumn, so these next few weeks, late summer into early fall, are the real turning point. My rule here is simple. Don't argue about bubble or no bubble, check the indicators instead. This isn't a signal to sell everything today. It means if you're overweight semiconductors, check your position sizing. And if hyperscalers make up a big chunk of your portfolio, pay closer attention to this quarter's earnings than usual. Honestly, when I first read this report, my gut reaction was, okay, this time it might actually be real. But reading the full note, even Hunter draws his own line. He calls it a setup to watch, not a confirmed conclusion. It reminds me of a doctor at a checkup saying this number looks a little off. Let's check again next visit. That's not a diagnosis of a serious illness. It's a flagged pattern worth monitoring at the next checkpoint. But headlines rewrite that into the doctor found something serious. You might still be thinking, Microsoft just had its worst month since the year 2000. Isn't that serious? Yes, that's real, and it shouldn't be brushed off. But at the same time, operating cash flow at these same companies is still growing. A stock price pulling back and a business actually collapsing are 2 different stories, and mixing them together is where people get scared for the wrong reasons. Let's wrap this up. JPMorgan really did compare this to the dot-com bubble. That part is true. But that does not mean a crash is happening right now. Chips exploding higher while the companies buying them wobble. That gap is the thing to watch between now and the start of fall. If you ignore this signal, you'll be the one panicking when a scary headline shows up in September or October. But if you're holding this checklist today, you already know exactly what to watch, and you won't get shaken. The market always wants a simple yes or no answer, but the people who actually stay ahead are the ones watching conditions, not chasing headlines. Now here's the thing, markets like this move fast, and there's always a new question worth digging into. So let's keep learning together. Subscribe so we can study the next big economic and investing story side by side, and if this video actually helped you today, make sure to tap that like button. It genuinely helps this channel keep going. Protect and grow what you've built.